Imagine waking up tomorrow and realizing your retirement savings barely survived the market's latest shock. Millions of Americans will face this reality in 2026. Unless they make one bold move today, in the next few minutes, I'll reveal the top 5 ETFs that could redefine your financial future, diversified, growth-focused, and designed to withstand volatility. We live in an era where market swings are unpredictable. Traditional savings accounts? Not enough. Individual stocks? Too risky. But ETFs, carefully selected, offer the perfect balance: growth, safety, and income potential. Whether it's U.S. market leaders, cutting-edge tech, or inflation-proof assets, these ETFs aren't just investments. They're your financial defense and opportunity rolled into one. Before we dive into the list, hit that subscribe button and tap the bell. Every strategy one reveal here is designed to give you an edge in 2026. Don't miss it. Diversification is the cornerstone of any resilient investment strategy, especially in today's unpredictable market environment. Simply put, diversification means spreading your investments across a variety of assets to reduce the risk of a single failure derailing your entire portfolio. When you concentrate all your money in one stock, sector, or asset class, you are highly exposed to volatility, economic shocks, and unexpected downturns. Exchange-traded funds, or ETFs, naturally support diversification because each ETF holds a basket of securities, allowing investors to gain exposure to dozens or even hundreds of companies at once. By combining multiple ETFs across different sectors such as technology, healthcare, energy, and consumer goods, you create a portfolio that is more resilient to market swings. For example, a downturn in the technology sector may be offset by gains in healthcare or energy, smoothing overall returns. Diversification also includes geographic spread. Investing in international ETFs provides exposure to emerging markets and global growth opportunities, reducing dependency on the U.S. economy alone. Additionally, blending ETFs focused on growth, income, and inflation protection ensures that your portfolio can weather a variety of economic conditions. The key is balance. Not all ETFs are equal, and understanding how different sectors, markets, and investment styles interact allows investors to construct a portfolio that minimizes risk without sacrificing potential gains. Over time, diversified portfolios tend to experience lower volatility, fewer drawdowns, and more consistent long-term growth, which makes diversification not just a defensive tactic, but a powerful tool to maximize returns in any market cycle. Low-cost ETFs are one of the most powerful tools an investor can use to maximize long-term returns, yet they are often overlooked in favor of flashy, high-turnover funds. The principle is simple. Every dollar you spend on management fees is a dollar that doesn't stay invested, compounding over time to grow your wealth. Even a seemingly small expense ratio of 1% can significantly reduce returns over a decade or more, especially when compared to ETFs with expense ratios of 0.05% to 0.20%. These low-cost ETFs achieve efficiency by tracking broad market indexes rather than attempting to beat the market through active stock picking, which often comes with higher fees and inconsistent results. By holding a diversified basket of securities within the ETF, investors gain exposure to the entire market segment at a fraction of the cost of actively managed funds. Additionally, low-cost ETFs typically have lower turnover rates, which minimizes capital gains taxes, further enhancing net returns. For long-term investors, the combination of broad market exposure, low expenses, and tax efficiency creates a compounding effect that can dramatically increase portfolio growth over time. Choosing low-cost ETFs is not about chasing the latest trends or hot sectors. It is a disciplined, evidence-based strategy that prioritizes efficiency, consistency, and long-term wealth accumulation. Investors who ignore the impact of fees are essentially letting a portion of their hard-earned money slip away every year, which can make a significant difference in achieving financial goals such as retirement funding, wealth preservation, or portfolio growth. U.S. market leader ETFs are a critical component of any well-constructed investment portfolio because they provide exposure to the largest, most influential companies driving the American economy. These ETFs typically track indexes like the S&P 500 or the NASDAQ 100, which include top-performing companies across multiple sectors such as technology, healthcare, finance, and consumer goods. Investing in these market leaders allows investors to participate in the growth of companies that have proven resilience, strong cash flows, and competitive advantages that often make them more likely to weather economic downturns. The advantage of choosing ETFs that focus on market leaders is that you don't have to pick individual stocks, which can be risky and require constant monitoring. The ETF automatically adjusts to include the dominant players as the market evolves. Historically, U.S. market leaders have delivered consistent returns over decades, driven by innovation, strong corporate governance, and the sheer scale of their operations. Furthermore, these ETFs often offer liquidity and transparency, making them accessible for both long-term investors and those seeking more flexibility in trading. By including U.S. market leader ETFs in a portfolio, investors gain a solid foundation of growth-oriented assets that benefit from the stability of established companies while still capturing upside potential. Because these companies are at the forefront of their industries, they often act as bellwethers for the broader economy, reflecting trends in innovation, consumer behavior, and sector performance. Sector-specific ETFs focus on particular industries or themes, allowing investors to capitalize on growth trends and emerging opportunities within the economy. Unlike broad market ETFs, these funds concentrate on a single sector, such as technology, healthcare, energy, or artificial intelligence, which can offer higher potential returns during periods of sector outperformance. Investing in sector-specific ETFs enables targeted exposure to industries that are positioned to benefit from long-term structural trends, regulatory shifts, or innovation cycles. For example, technology ETFs capture companies leading in cloud computing, semiconductors, and AI, while healthcare ETFs focus on pharmaceuticals, biotechnology, and medical devices driving advancements in patient care. These targeted funds are particularly useful for investors looking to overweight certain areas of the economy without taking on the company-specific risks of individual stock selection. Sector-specific ETFs also provide diversification within the sector itself, as the fund typically holds a range of companies at various stages of growth, reducing the impact of any single company's underperformance. Additionally, they allow investors to adjust their portfolios in response to macroeconomic conditions or personal investment objectives, such as adding exposure to renewable energy during the global shift towards sustainability. While sector-specific ETFs carry higher volatility compared to broad market funds, the potential for above-average growth can make them a strategic component of a diversified portfolio. By carefully selecting sectors with strong growth potential and long-term relevance, investors can enhance returns while maintaining a structured, risk-managed approach to capital allocation. Global exposure ETFs are designed to provide investors with access to international markets, allowing portfolios to benefit from growth opportunities outside the domestic economy. By including companies from Europe, Asia, emerging markets, and other regions, these ETFs reduce dependence on the U.S. economy and create a more balanced investment approach. Global exposure is particularly important because different regions experience economic cycles, interest rate changes, and growth trends at varying times. While the U.S. market may face slowdowns or volatility, markets in emerging economies or other developed nations can offer alternative sources of return. These ETFs typically include a diversified mix of sectors and industries, spreading risk across multiple countries and companies, which can help mitigate the impact of localized economic or political disruptions. In addition to growth potential, global ETFs allow investors to participate in sectors that may not be heavily represented in domestic markets, such as renewable energy in Europe or technology and manufacturing in Asia. Currency fluctuations and geopolitical events introduce additional considerations, but over the long term, exposure to international markets has historically improved portfolio resilience and overall returns. Global ETFs also facilitate easier access to foreign markets without the complexity of buying individual international stocks, handling taxes, or navigating local regulations. By strategically including these funds, investors can enhance diversification, reduce concentration risk, and position their portfolios to capture the expanding economic influence of international markets alongside domestic holdings, ultimately strengthening the foundation of a balanced investment strategy. Dividend yield ETFs focus on companies that consistently pay dividends, providing investors with a reliable income stream while maintaining exposure to potential capital appreciation. These ETFs are particularly attractive in uncertain or volatile markets because they offer stability that pure growth-focused investments may lack. By pooling dividend-paying stocks across multiple sectors, these funds reduce the risk associated with relying on a single company or industry for income. High-quality dividend-paying companies often have strong cash flows, solid balance sheets, and a history of weathering economic downturns, which makes them more resilient to market shocks. Dividend yield ETFs also allow investors to benefit from compounding, as reinvested dividends can generate additional returns over time, enhancing the overall growth of a portfolio. Beyond income generation, these ETFs can serve as a defensive component within a diversified strategy, helping to offset losses in other, more volatile assets. Additionally, many dividend yield ETFs focus on dividend aristocrats, or companies that have consistently increased dividends over many years, signaling stability and management discipline. For long-term investors, this combination of income, stability, and growth makes dividend-focused ETFs a valuable tool for building wealth while managing risk. They are also well-suited for retirement portfolios or investors seeking cash flow without the need to actively trade individual stocks. By incorporating dividend yield ETFs into a broader portfolio strategy, investors can create a balance between consistent income, risk mitigation, and participation in the equity market's long-term growth potential. Inflation-protected ETFs are designed to safeguard an investor's purchasing power in an environment where rising prices erode the real value of money. Unlike traditional equities or bonds, these ETFs invest in assets that adjust with inflation, such as Treasury inflation-protected securities, TIPS, or commodities, ensuring that the portfolio maintains its value over time. Inflation can have a significant impact on long-term investment returns, as even modest increases in the cost of living reduce the real gains earned by a portfolio. By including inflation-protected ETFs, investors hedge against the risk that fixed income or cash holdings may lose value in real terms during periods of rising prices. These ETFs often provide a balance between growth and stability, combining the safety of government-backed inflation-linked securities with the flexibility of a diversified fund structure. Additionally, inflation-protected ETFs can complement other portfolio components, such as growth-focused or dividend-paying ETFs, by adding a layer of security that reacts favorably to changing economic conditions. They are particularly valuable during periods of economic uncertainty, when inflationary pressures can accelerate due to supply chain disruptions, monetary policy shifts, or global market imbalances. Investing in these ETFs allows for consistent real returns, reducing anxiety about market fluctuations while preserving wealth over time. For long-term investors, the inclusion of inflation-protected ETFs ensures that a portfolio is not only diversified across sectors and geographies, but also resilient to the hidden risk of rising prices, maintaining both the purchasing power and the growth potential of invested capital. Timing and rebalancing are essential strategies for maintaining a healthy investment portfolio, ensuring that risk remains aligned with an investor's goals while maximizing potential returns. Markets are constantly fluctuating, and over time, the allocation of assets in a portfolio can drift from the original target due to varying performance across sectors, asset classes, or regions. For example, if equities outperform bonds for a prolonged period, the equity portion of a portfolio may become disproportionately large, increasing exposure to market volatility beyond the investor's comfort level. Rebalancing involves periodically adjusting the portfolio back to its intended allocation, which can include selling assets that have grown too large and buying those that have lagged, effectively enforcing a disciplined buy low, sell high approach. Timing, in this context, doesn't mean predicting short-term market moves, but rather consistently contributing to the portfolio and strategically rebalancing at intervals that fit the investor's objectives, such as quarterly, semi-annually, or annually. This disciplined approach prevents emotional decision-making, reduces the temptation to chase market trends, and ensures that the portfolio stays aligned with long-term goals. Automated investment platforms and ETFs make rebalancing more efficient, as investors can adjust allocations without having to trade individual stocks manually. By adhering to a timing and rebalancing strategy, investors can smooth out returns over market cycles, manage risk effectively, and maintain the integrity of a diversified investment plan. This systematic approach reinforces long-term wealth accumulation while providing structure and consistency amid market uncertainty. In conclusion, building a strong investment portfolio in 2026 isn't about chasing trends or gambling on the next hot stock. It's about strategy, discipline, and positioning yourself for long-term growth while managing risk. By focusing on diversified, low-cost ETFs, U.S. market leaders, sector-specific opportunities, global exposure, reliable dividend yields, and inflation protection, and by implementing consistent timing and rebalancing strategies, investors can create a portfolio designed to endure volatility and capitalize on opportunity. Each component plays a distinct role: stability, growth, income, or protection, working together to build a resilient financial foundation. The markets will always have uncertainty, but with a structured approach and thoughtful allocation, you're not just reacting to the market, you're preparing to thrive in it. This is the difference between a portfolio that survives and one that truly grows. The choice is clear. Take control, make your investments work intelligently for you, and approach 2026 with a plan that balances risk and reward, ensuring your financial future is secure and positioned for success.